All right. Welcome to the Thriving Money Show. This is a show where we're going to help you to take that money, make it multiply 3 to 4 times, learn how to protect your money, protect it via life insurance, a trust, making sure that you have all your eggs in your basket. And also, we will be having special guests on this show where we will be revealing and unpacking the secrets and the stories to how these individuals have built their wealth. So tonight, this is episode 2. So again, I always said for the first 2 shows, I wanted to make sure it was me setting the foundation, and this is a part of the foundation. One of the things that we have to understand about money, we're going to talk about really 3 things today. Number 1, I'm going to talk to you about what is life insurance, like what are the different types of life insurance, and what are some of the secrets of the affluent when it comes to life insurance? Some things that you may not know, some things that you were not taught in school and you were not taught in the financial industry. Within this next 10, 15 minutes or so, when I talk about the 10-minute lesson on life insurance, you will understand more than most financial advisors understand about life insurance, and you're going to learn how you can use it to make you wealthy if you use it the right way. I'm also going to talk to you about how I personally have used my policy to make my money multiply 3 to 4 times off the same dollar. And when I say use my policy, I'm referring to how I use policy loans to make my money multiply. And then I want to talk to you about just the system. And I think I'll start here about the system. And this is why we need the information, why we need the education about this, because if we keep doing things the traditional way, we will be burnt, right? I did a post on Instagram. It was talking about, when you're making $100,000 on your job, that's when it's scary because they're paying you to be in golden handcuffs. They're paying you to stay stuck on a job, and you better have a passion for it, because a lot of people stay stuck on a job and they have no passion because they just don't know any other way to turn. There are different ways. I'm not saying that everybody is meant to be an entrepreneur, but what I am saying is that if you learn these secrets to the investment world, these secrets to leveraging your money, you won't have to stay an employee for long. It's one thing to go to work because you want to. It's a totally different thing to have to go to work every day because you absolutely have to. And my job is to make it a want and not a have to. Look, the first thing we have to do, you all, to break free of the system is to understand that it is possible. It is possible for you to live the life of your dreams. It is possible to make a lot of money. I did a post. I got to show you all this, right? So I did a post on Facebook, and I had a really, really big day in my industry where, I got a deposit in my account for one day of $692,000. Now, guarantee you this is absolute real. It was from my bank account statement. And the reason why I show people that, not to brag or not to boast, but I want people to understand what's possible in business. So many people, they never achieve because they never seen any examples. So I say, you know what, let me give people an example and let people to know, give people some advice and some inspiration to know how they can do the same thing, right? These are some of the responses that I got, right? And I'll read the exact post to you. I'm reading this because you may not know what's possible with your insurance, and I'm going to tell you today. So it said, keep going. This industry can be very profitable. We are helping a lot of people, and we deserve to get paid for the good we do in the world. These were deposits in my account in one day. Seek mentorship, stay consistent, and work smart. In this business, you will work a lot for a little early, and you will work a little for a lot later. Okay? Nothing wrong with that, right? Being inspirational, providing motivation. Let me tell you what some of the comments said. Just be careful not to set improper expectations. You say profitable, but then you post deposits, which are only gross revenues or one part of the equation. What about your expenses? What about taxes? What about these things? Also, many of the deposits are loans of unearned income until the client actually pays a premium for the set number of months. Most new agents won't notice these differences. Please post your total expenses and your tax returns so that newer people in the industry will go a clearer, candid expectation. So just to be clear, I just showed what was possible in this industry, and I was told to show my tax returns. That's just one. Number two, why do I get the feeling that if you're posting a random screenshot, that could be anyone's, including their cult leader, wouldn't flex this kind of coin on a Facebook group, has to be fake? Okay, that's number two. I'm telling you, I got attacked. Here we go. What about, hold on. Can you provide me some context and some tax returns? My curiosity from the bank, you only had $150,000 in the bank. If you're doing these kind of numbers, wouldn't your account be reflecting it? I don't believe you. I mean, I'm talking about tens of, not 20 messages at least, back to back to back, all negativity, right? Why do I say this? Because some people will rather fight for their mediocrity than to fight what's possible. Who are you? Are you the person that actually believes that something that can be achieved? Or are you the type of person that's going to argue against? Look, not one person said, this is awesome. How did you do it? Can you train me? Can you mentor me? Can you coach me? And that's the problem with this society. Everyone says, well, nobody ever showed me the way. But when somebody shows you the way, you actually run away from the truth of what's possible so that you can fight for your limitations while at the same time saying that you're going to get to this goal. You want to get to a goal that somebody else has gotten to, and you shut it down. Do you do the same thing when you see somebody that might be rich on the street? When you see a rich person, how do you respond? How do you react to that person? Do you react to that person saying, man, how did they do it? Or do you react to that person saying, that person must be a crook, they had to do something? I'm telling you, most people respond the latter. And you should, not you. I'm telling you, what you believe and what you can celebrate for somebody else, you can celebrate for yourself. So what this society teaches us is the old way, which is why no one can even believe in success. They teach you to save in your 401k, overfund it. You can't touch it until you're 59 and a half. Maybe one day when you're 65, you can retire. Maybe one day you can actually spend your money. And oh, by the way, when you think you can spend that money, guess what? When you believe you can spend that money, well, we're going to tax you to death. So that way we take the money. We tax you, right? This is a crazy way to think about life. You didn't just spend all of your life just to work hard, pay back your student loans, and barely make it in retirement. If that's the life you signed up for, if that's what you're passionate about, then you may not need to watch this video. This video is for the people who actually believe that something is possible. So let's go ahead and get into it. I'm going to go ahead and share my screen and show you a really quick 10-minute lesson on life insurance. So if we can pull that up, that would be great. All right, perfect. Now, this is powerful. I want you to pay attention, share it with your friends, share it with your family, subscribe to this channel, because these are the type of nuggets I'm dropping. So let's just say hypothetically, you can get a $500,000 death benefit. Well, there's a minimum amount that you can pay to get that $500,000 death benefit. And there's also a maximum amount that you can pay to get that same $500,000 death benefit. Now, let me ask you a question. Who do you believe? Write it in the chat. If you're watching this on YouTube, maybe Instagram, write it in the comments in the chat. Who do you believe determines the minimum amount that you can purchase to get that $500,000 death benefit? Who do you think determines that? Give you 3 seconds to guess. Okay. If you said you're incorrect. If you said the government, you're incorrect. If you said the insurance companies, then you would be correct. The insurance company determines the lowest amount because they actually have actuaries and underwriters and all of these number crunchers to determine what's the least amount that we can charge people and actually make a profit, right? Well, Then you have the maximum. And who determines the maximum? It's the government. Question for you. Why would the government be even a slightest bit concerned of how much money a person will put into a life insurance policy? Could it be that the government cares about one thing, and that is taxes, right? That is taxes. So there are many ways to design these types of products. But what the government said is that, well, here's what we're going to do. So that we don't have millionaires dumping millions of dollars into these policies to avoid taxes, we're going to create our own plan. People don't realize life insurance was the way to go years ago. Well, in the 80s, they said, well, we're going to create qualified plans. Well, what's a qualified plan? A qualified plan is your IRA. It is also your 401k. It is also your SEP IRA. It's also your 403b plan. Also a thrift savings plan if you work for the government. A 401a depending on if you work for a government agency. Look, any qualified plan on your job is typically what the government created in the 1980s or an individual IRA. Now, let me tell you just a little bit about the qualified plan. They defer the tax and they also defer the tax calculation. So again, they don't just defer the tax. They tell you that, well, when you put the money in here, you're going to write it off and you're never going to have to pay taxes on it again. But they also defer what the government decides to charge you. If the government decides to raise their rates at the last minute, guess what? You pay for it retroactively to the day that you gave the government the money. So what tax bracket will you be in retirement? And what deductions will you have when you do take the money? Most people have less deductions in retirement than they do when they were working, right? So if you overfund this policy, they created this line, said, you know what, we're not going to let millionaires just dump millions of dollars into the policy. We're going to create this line. It's called a MEC. What a MEC means is a modified endowment contract. In order to avoid a modified endowment contract, you can't dump large amounts in at one time without it being taxable. You must follow what's called the 7-pay rule, which means you need to fund it over at least a certain amount of years to avoid the taxation. Now, if you don't avoid the taxation, it's going to be taxed just like your IRA, just like your 401k, just like your retirement plan. So you need to be careful about that. So let's just say the minimum was $500. The minimum that you can put in was $500. And the maximum was $10,000. Now, you all are smart people. If you had to guess on, should I put 500 in or 10,000? Most people are going to say 500. Well, if you put in 500, what type of insurance is that called? Term. Term has only one benefit. That is a death benefit. That's a death benefit. Okay. So if you're going to put in this much money, there we go. It's a death benefit. So if you're going to put in this much money, 10,000, it better have some good benefits. So what are those benefits? What about tax deferred growth? Just like your qualified plan so far, tax deferred growth. You don't pay any growth. But also the difference is tax-free distributions. What that means is that you don't pay taxes on the deferral and you also don't pay taxes on the distribution. So far, it's similar to a Roth IRA. However, there's a few more advantages. Competitive return, very high contributions compared to a Roth. You get additional benefits such as long-term care, disability, etc. There are collateral opportunities, which means that you can borrow against your cash value, which you can't borrow against a Roth. It's safe. Now, a Roth is going to be in a market, so it's going to go up and down. So it's very safe. Also, no loss provisions. You won't lose your money. Guaranteed loan options, which means when you go to get a loan, you don't have to have the best credit score. Nobody's checking your credit score. Nobody's checking to see if you have a job. No one's checking that. In fact, if you have any cash value built up whatsoever, then guess what? You are going to be able to take advantage of this. Unstructured loan payments. What that means is you don't even have to pay it back. Did you hear what I said? You don't even have to pay it back. Well, what do you mean you don't have to pay it back? You don't have to pay it back because if you don't pay it back, It's simply subtracted from your death benefit when you die. And your death benefit is always much more than the cash value. So if I have a $100,000 cash value, I probably have a $500,000 death benefit. So if I borrow $90,000, if I don't pay it back, they're going to charge the $90,000 plus interest when I die, and my heirs are going to get the remainder of that, whatever was left from that $500,000 death benefit. You also have liquidity, use, and control of your money. What that means is I don't have to wait until I'm 59 and a half like I had to on my job and my 401k and my retirement plan. In fact, most of these policies, I can contribute to it. And if I do it the right way, I can borrow against it within 30 days. That is a powerful, powerful concept. So when we structure these policies, you all, we want to structure it for the lowest amount of death benefit possible. The lowest amount of death benefit and the highest amount of cash value. Now, when we do this, we create a policy that's less fees and supercharge the growth in that portfolio, in that cash value. Why? Because the fees are all in the death benefit. So if we lower the death benefit, we're only paying fees on the amount that's a death benefit, and we're paying very limited fees on the cash value, which drives down your cost, which is like a 70% decrease with most insurance agents, because most insurance companies and agents don't do it this way. Some companies can't even do it this way. And some advisors don't even know about this way. And if they do know about it, they don't want to tell you about it. Why? Because it is hard to get a man to understand something that their wallet depends on them not understanding. Did you catch that? It's hard to get a man to understand something that his wallet depends on him not understanding. Well, let me take it to the ladies too. It's hard to get a lady to understand something that their pocketbook depends on them not understanding. Okay? If they understood it, they would be taking a 70% pay cut for the rest of their career. Not everybody is willing to do that. We are. That's why if you go to wealthcreationcall.com, wealthcreationcall.com, we will actually set up your policy for you complimentary, no fees. That's impressive. So we're going to create this maximum efficient contract. Maximum efficient contract. That's what we're creating for you, with increasing cash value so that the death benefit grows as the cash value grows. Okay, so let's go ahead and take me back to full screen. All right, so as you can see, you all, what we are looking to do, we are looking to build a legacy. We are looking to do this the right way. Okay. Now, if you do have a, I would say a regular IRA, and you might be wondering, what should I do with that IRA? Well, one of the questions that I get is, well, should we ever take our 401k and just liquidate it now and just put it into this policy? Well, no, I wouldn't do that, because if you're under the age of 59 and a half, you're going to have to pay taxes on this particular policy. You're going to have to pay taxes on this policy. And if you're under 59 and a half, you're going to have to pay a 10% penalty. That could be 40% in taxes and penalties. So it doesn't make sense to take a 40% discount on your money just to put it into the life insurance policy. But I would start fresh from here on out. Let me show you an example of when you have good financial planning, how much extra money you can have. So we can go ahead and pull up the screen again. I want to talk to you about converting your money from a traditional IRA to a Roth IRA. That means if you have an IRA, if you left an old company and you rolled that money over into an IRA, if you take it out, it will be a 10% penalty, but you can convert it to a Roth without that penalty. That means all of your future growth. So the money you have now is tax deferred. You take that money out, and what you do is you put it into a Roth. You pay taxes on a smaller amount. So let me kind of explain it to you what I mean. Let's just say hypothetically, This is my business. However, I have a partner in that business that's, let's call him a 30% owner of my company. But one problem, this partner is very lazy, which means this partner isn't doing any other work. Yes, your business is growing, which is great, but your business is growing and you're doing all of the work, and you got somebody else that's taking 30% of the business. Now you're presented with an opportunity to buy this person out. You can buy this person out and say, hey, here's your 30%. Just get out of my business and I'm growing, because you know this business is going to grow. You got some ideas that are off the charts and they're just going to blow up. What if you decided not to? Okay, let's look at the difference. So you decided not to. Your business grows, but so does your partner's position. Not only that, you have a clause in there that if he's still with you at the end of 5 years, taxes could go up. His partnership percentage could go up. So now they're taking this much of your business. Let me ask you a question. Would it have been better to buy it out at this point or wait until you owe this amount? Would you rather pay taxes on the seed, or would you rather pay taxes on the harvest? So do you get what I'm saying? Okay. So now that you understand that it's better to convert the money when it's less so that it can grow tax-free later, and you don't have that partner. That partner represents the IRS. That partner represents the government. Okay, so let's talk about this. So first thing you have to do is decide whether your retirement tax rate will be higher or lower than your current tax rate. So what do you think, you all? You think taxes are going to go up or go down? So second, to convert, you got to think about an alternative to converting. So you can invest those dollars. If you invest wisely and successfully, the investment may be more valuable than the tax savings from the Roth IRA. That means if I never had to pay the taxes, but if I invested the money, I paid the taxes and it went crazy, then, okay, well, that's something that we have to consider. So let's explore which situation is best for you. So let's just say your current age is 42, your retirement age is 65, and you're projected to live into, let's say, age 90. You have $100,000 in your IRA. It's growing at 5%. The accumulation tax rate is 30%, which means as you're accumulating, you're paying 30% taxes. When you retire, you're going to be distributing income of 5% per year from your portfolio to make it last. And when you distribute it out, that's still at a 30% tax rate. What is that going to look like for you? Well, the after-tax income, so we're at Roth IRA conversion calculator, a comparison of after-tax income during retirement. The after-tax income from the traditional IRA, $370,359. That means the income that I'm taking from that money on an after-tax basis, after I consider all taxes, is $370,000. The after-tax income from the conversion tax account is $98,000. What that means is the money that if I would have converted it, I would have had to pay money to pay the taxes. So if I would have invested that money, I would have been able to pull out $98,000 from 434 in income. And I'll show you what that looks like in a second. So the total income from traditional and conversion tax accounts is $468,000. The total income from the Roth IRA is $529,000. So based on the after-tax income, the Roth IRA is better by $60,291. But let me show you what I'm talking about here. Okay. Let's see how I can explain this. So my traditional IRA balance is $307. The estimated taxes due was $92,146. So the traditional IRA tax value is $215,007. The conversion tax account is $66,183. So total traditional IRA is $281, Roth IRA $307. Based on after-tax values, a Roth is better. So if I looked at documentation, which let me show you. documentation here, traditional. So not only is my account worth more, but also I have more income. So $100,000, not touching it, and just taking income when I'm 65. This is what I'm talking about here. I have took a total cumulative amount of $370,000 right here. Okay. And I know it's kind of hard to see, but now I would have had to pay $30,000 because remember I have 100,000 and it's 30% conversion rate. So that's $30,000. Had I invested that 30,000, I would have been able to draw income of 3,785 per year at 65, which would have been 98,433. And if I just did the Roth IRA conversion, pay the taxes one time, never again, all of this money is tax-free. That's $529,083 of tax-free money. So basically, you all, what I wanted to show you, you can take it back up to my screen. The reason why I wanted to show you all this is that I wanted you to understand the power of tax planning. You have to understand when you are investing your hard-earned money, it's not just about how much I can grow my account. It's also about how much can I keep. It's also about how much could I save in taxes. And that is extremely important. So with this show, the Thriving Money Show, we will be doing, oh my God, we're going to be doing so much when it comes to planning for your retirement. We're going to be talking about, different ways that you can make money in your business, how you can have a career opportunity. A lot of people want to know, what made you a 7- and 8-figure earner? Well, it's the financial industry. So I actually do coach people how to be in the financial industry and how they can earn a great living, multiple 6 figures, sometimes even 7 figures doing the business of what I do. So 2 steps. Number 1, you can, make sure you subscribe to this channel, share it with a couple of friends. Number 2, you can follow me on Instagram, Marvin Mitchell Official. That's Marvin Mitchell Official. And then number three, which is very important, you can actually get you a policy set up by my team, and we can start you down the retirement journey. And you can make sure that it's done right by simply visiting. It's in the description, but you can visit wealthcreationcall.com. That's wealthcreationcall.com. I am also having a mastermind in. Yes, that's it. wealthcreationcall.com. So when you go to wealthcreationcall.com, which is on the screen now, you can claim your complimentary 15-minute call. If you want to stop the threat of taxes from destroying your financial freedom, if you want to recapture money that you are losing unknowingly and unnecessarily, and if you want to securely extend your wealth to the next generation without taking a huge risk, you can claim your complimentary 15-minute call now. So with that being said, you all, this week, I usually go live on YouTube as well as Instagram. Some glitch that I'm having on Instagram. I can't understand why, but we will be back next week for those of you who do like to watch me either on YouTube or Instagram. But if you're watching on Instagram by chance, make sure you go to the Thriving Money Show with Marvin Mitchell and subscribe to my channel. Yep. Okay. Looks like we got a question, you all. So let me go ahead and check the question in the chat. Hi, do you know which underwriter Christina was? Hi, do you know which IUL underwriter Christina Yvette was speaking of that you're able to deposit your paycheck into and then get it back out? Yeah, that has nothing to do with the underwriter. That's a type of policy. So that's going to be a whole life policy where you can actually. So when I say you can dump premiums in and then you can borrow against it, one strategy is to dump your premiums into, which reminded me, I forgot to tell you some of the ways I made money off my policy. You can actually dump your some of your paycheck into the policy, then borrow against it to pay your bills. So let's say if you make $100,000 and you put in $70,000, and then you borrow the $50,000 out to pay your bills. Now you have that entire $70,000 growing for you uninterrupted as if you never touched it. The second way is you could just spend the $70,000 and it's gone and lost forever and you're never making any money off the $70,000. So the wealth creation fund is basically a fund to, once you put the money into that fund, it will continue to grow. So it's a very, very great tool, very great resource. So that's a great question. Thank you for asking that question. So some of the ways that I've made money 3 to 4 times off the same dollar. Number one, I was able to borrow against my policy to buy a $2 million house in Atlanta. And that's where my mastermind will be. It's going to be on the 26th of January, and I do it every quarter. So if you're watching this late, the next one might be in April. And I do it at my mastermind because I want to show people in my mansion, because I want to show people what's possible, and I want to inspire people. And quite frankly, I rent this out and it makes me money. So I borrow from it. Sometimes it makes me up to $20,000 a month. I pay it back, and then I just got a profitable venue that I didn't have to use my own money. I just borrowed against it. I've also used it to borrow against it to buy my Lamborghini, and I made money off the Lamborghini simply by having it. A lot of people wanted to join my mentorship programs by having it. At one point, I was renting it out, but I decided against that because I didn't want anybody to destroy it. But I did it for a while. Another way I've made money is to loan out money. So, for example, this is really great. So a lot of people wanted loans. They did these high interest loans to borrow for real estate. They were charging horror money lending. We're charging 15, 20%. Well, I borrow from my insurance policy. I might charge them 10 or 11% and write their house as collateral if they don't pay me back. And I just made money off my insurance, and I made money off the loan that they gave me back. Never had anybody default. If they would have defaulted, I would have took their house and sold it at a profit. Okay. I've used it to borrow against it to trade options, to option trade. Made a lot of money doing that. I bought a big apartment building utilizing the money. So with a couple of different partners. So there's so many different ways, but my favorite way is to get business funding, right? Get business funding credit. Once I get that business funding credit, what I do is I turn it into cash, and then I buy a real estate asset, right? So I bought the real estate asset. Now I can borrow from my cash value to pay off the credit card. Now I'm making money off the insurance policy as if I never touched it. I'm also making money because I got the points I can travel with, get hotels from the points from the credit card. Don't have any debt on the credit card anymore. And I'm making money on a real estate asset. And once the real estate asset grows enough, now I can borrow from the equity in a real estate asset, and then I can go out and buy me another real estate asset. So now I just made money 4 times off the same dollar. And then if I want to protect all of those assets, I just get me a trust, the right type of trust that will protect all of my assets. And I can even save a little bit more money in taxation, and also protect my assets from lawsuits, protect it from estate planning, taxes, etc. So there are so many ways. This is some advanced things that you can do when you learn how to work it. So don't just stick to traditional advice. My advice to you would be to open up your mind, understand what's possible. Don't be like the people who criticize me just because I attempted to inspire them. Be like the person who believes, and you said, what if this is possible? Not it's not possible. What if it was possible? If this was possible, what would that do for me? What would that look like for me? What would that look like for you? With that being said, you all, I am signing off. The Thriving Money Show. Catch us back same time next week, 7 p.m. Eastern on Monday, and we will continue with the 3rd episode of the Thriving Money Show, and hopefully we have a great special guest. So you want to make sure that you tune in. Thank you.